Hey guys, Jim Schultz back with you guys for the Greeks Crash Course, and we are now into episode number 4 on gamma. And to be real with you guys, this is where things start to get a little slippery. Like, we've moved beyond the first order Greeks, your deltas, your thetas, your vegas. We're now going to crack into those second and third order Greeks, kicking things off here with gamma. But hopefully, because we're going to maintain the same structure, that will help to keep us, i.e. me, on track. So we're going to cover 4 things: what the Greek is, how we use it, how it can improve our returns, and how it can decrease our risk. So without further ado, let's dive right into episode number 4, gamma. All right, so what is gamma? Well, let's break down the what it is segment into the same 2 parts that we've been using all throughout the crash course to this point. Let's talk about the mathematical side of things, and let's talk about the intuitive side of things. So mathematically, gamma is fairly straightforward. It is a second derivative of the Black-Scholes option pricing model. It is the second derivative of the Black-Scholes option pricing model, first with respect to price, and then second with respect to price again. So effectively, what it tries to measure is the change of a change, just in a general sense. In a more specific sense, it measures how delta changes, because remember guys, delta is the first derivative of the Black-Scholes option pricing model with respect to price. So gamma is the change of delta. Okay, so now that we have a mathematical basis, what about the intuitive side of gamma? Well, this one is going to kind of be a lot to digest, so try to stay with me here for the next couple of minutes. But in just a general sense, if we were to think of like a car that's already moving, that movement of the car is basically measured by 2 different things: the speed of the car and the acceleration of the car. Well, if we take that idea and we translate it back into an options context, to a Greeks context, the delta would be the speed of the car, the gamma would be the acceleration of the car. So it's measuring how the speed changes. It's measuring how the delta changes. All right, so now that we have at least a loose grasp on the intuitive understanding of gamma, here's the next very important element that you want to add to your foundation. The magnitude of gamma is not nearly as important as simply understanding the sign of gamma and all that that entails. Now, I'm going to unpack a lot more behind why this is the case in the next few minutes, but let's begin by building our foundation by understanding the sign of gamma is what really matters. Now, similar to Vega, long options have positive gamma and short options have negative gamma. A pretty simple concept to understand, and it sounds easy enough. But the positive and negative gammas and what they actually mean, what they actually represent, are anything but easy. If you have a long option with positive gamma, what that means, or what that begins to mean, is that your delta is going to change in the same direction as the stock price movement. If you have a short option or negative gamma, that means that your delta is going to change in the opposite direction of the stock price movement. Okay, now that probably doesn't make a ton of sense yet, so let's work through a couple of examples. First off, let's say you had a long call, very simple bullish strategy. This is going to be positive gamma. Here is what that means. If the stock were to rally, what you want to have happen, your deltas will actually increase. If the stock were to go down, what you don't want to have happen, your deltas will actually decrease. In other words, if the strategy works, right, bullish strategy, the stock goes higher, your deltas will strengthen. But if the strategy doesn't work, right, bullish strategy, stock goes lower, your deltas will actually weaken. Now, conversely, let's say you had a short call on. This is going to be a negative gamma position. Here is what that means. If you have a short call on, this is a bearish strategy. Well, what happens if the stock rallies? If the stock rallies, your deltas are actually going to go down. But since this is a bearish strategy with a short call, those deltas are negative. So they're going to become more negative, which is going to make you even more bearish. But what if the stock actually goes down on your short call? This is what you want to have happen, where your deltas are actually going to increase. Or in this case, since it's a negative number, they're going to become less negative, which means you are less bearish. Okay, now those two simple examples, believe it or not, a long call and a short call, they can be extrapolated out to any long option strategy and any short option strategy. So that's the good news, right? The principles that we learned with long calls and short calls in relation to positive gamma and negative gamma are going to be the same for any long option strategy and any short option strategy. Whenever you buy premium, you're going to be positive gamma. Whenever you sell premium, you're going to be negative gamma. Now, as focus primarily on selling premium, we are almost always going to be negative gamma. So that means that our directional biases can strengthen, they can weaken, they can flip over from one side to the other where we were bullish, but now maybe we're bearish in a strategy like a strangle because of negative gamma. Now, the last piece to this is remember all the protocols, all the mechanics, all the adjustments, all the defending losers and managing winners that we put in place in the strategy management crash course that we released a couple of months ago. That all starts, that all centers around this idea, this awareness of negative gamma and the consequences and implications of what that means. All right, so what about increasing returns? Well, gamma is a very interesting Greek because there are many traders in the marketplace that actually do try to use gamma to increase their returns through a process that is oftentimes referred to as gamma scalping. Now, the idea behind gamma scalping usually relates to long options, so positive gamma, and it's a situation where a trader tries to capitalize on the times when they are right directionally and they let that positive gamma continue to build up and work in their favor. However, we actually believe wholeheartedly in a market that is random, in a market that is unpredictable. So that's not typically a strategy that we like to employ. We actually prefer to take the other side of that trade in a process that some might call reverse gamma scalping. So rather than try to be right directionally, rather than try to pile on, in those times when we happen to nail a directional move, we actually prefer to lessen the impact of direction and place a greater emphasis on vega and theta, these non-directional metrics, these non-directional elements. This is what reverse gamma scalping actually looks like without getting into all the details because that is way beyond the scope of what we're trying to do here. But the most important thing about this section inside of this episode is this. We don't really focus on gamma too much in regards to improving our returns. We focus on gamma in regards to controlling our risk, which brings us to our next point. Okay, so what about decreasing risk with gamma? Well, this is where our approach to gamma, our approach to this Greek, and our proprietary management techniques, this is where these guys really begin to shine. First off, let's make sure that we all understand that undefined risk strategies are the best way forward to consistency. Consistency with results, consistency with profitability, consistency in a number of different ways. It's that pure, unfiltered exposure to the Greeks that's going to allow you to achieve those consistent results. So that would be a gimme, as some might say. Well, you might naturally be wondering, all right, Jim, where's the gotcha? Well, it's right here. When you have undefined risk strategies on, you are naturally exposed to unlimited potential losses. Unlimited potential losses in way of directional moves, unlimited potential losses in way of implied volatility changes. So a pretty sizable gotcha. Now, to mitigate this, we want to start by understanding and recognizing gamma's natural drift. Gamma moves higher the closer to expiration you get. It doesn't matter what the stock is. It doesn't matter what the strategy is. It doesn't even matter what the specific moneyness of the option is. At the money, out of the money, in the money. This is how gamma just naturally wants to move. So we combat this, we mitigate this risk by managing all of our undefined risk positions at 21 days to go. Doing this, it puts a natural cap. It puts a natural ceiling on just how high gamma can really go. And so what this does for us is it allows us to better control our directional risk without having to monitor the exact magnitude of gamma as we referenced earlier. Not to mention, our research has actually shown a very interesting finding. Most of the big outlier moves, most of the big outlier losses that have occurred in the marketplace in the last 15 years, most of these guys have occurred in the second half of the expiration cycle. That means inside of 21 days to go. Now, you might see that, and at first glance, you might think, oh, that's just a coincidence. But if you stop and think about it a little bit, it makes mathematical sense, because at the end of an option's life, as you get closer and closer to expiration, this is when everything gets heightened. This is when all the Greeks begin to grow in magnitude, including gamma. So seeing a situation where most of the big losses occur in the second half of the cycle, it actually makes mathematical sense. And we can avoid some of those at least by simply managing at 21 days to go. Wow, guys, believe it or not, but we are now at the end of episode 4. Gamma, this guy is over, this guy is done with, this guy's in the rear view mirror. So if you want to do us a favor and share this video with one of your trader friends, that would really help us out. And make sure that you save this episode for future reference. And then when you guys are ready, I will see you in episode number 5, where we are going to talk about the Greek that gets no love, Rho. We'll see you there.